Joining me now is Jason Trennert. He is chairman of Strategas Research Partners, now a Baird company. Jason, thank you so much for joining us. How's it going?
Oh, everything's going great. Thanks for having me.
It's good to see you. 5%, we haven't really been in that territory in quite some time, but that might allow a lot of people to breathe a sigh of relief over stocks.
Yeah, I mean, I think we actually, if you remember, we were there briefly in late October of last year, and the S&P 500 hit 4,100, barely 7 months ago. So I would say a lot of the academic research suggests that investors tend to switch between, from stocks into bonds at rates above 5%, and we had a pretty good example of that towards the end of last year. The big difference at that time was that Janet Yellen and the Treasury Department changed their funding schedule to focus much more on the short-term part of the curve as opposed to the long-term part of the curve, and it worked. It brought long-term rates down. And so I think we have a pretty good line in the sand of what causes trouble.
That's really interesting.
For the time being, I don't see a lot that'll move it past 5, but that's what we're watching.
Sure. And maybe it's only the Treasury that can respond at this point. But, not to ask kind of a silly question, but how connected is Fed policy to where you think the 10-year goes at this point?
Well, listen, I think the problem is there's absolutely no coordination, it seems to be, between fiscal policy and monetary policy, right? So the Fed is doing its best. It's increased rates from 0 to 5.5%. It's brought its balance sheet down from $9 trillion to about $7.5 trillion. At the same time, the federal government is spending money like there's no tomorrow. We're running budget deficits of 7% of GDP at what is essentially full employment.
Yeah.
It's unheard of. We've never done that. And it does present, I will say, Kelly, I'm constructive for this year, but it does present a long-term risk for long-term interest rates and inflation, in my opinion.
Well, I wonder, again, you can't help but speculate a little bit. Okay, so they're dialing back on quantitative tightening. How convenient.
Yeah, no, and listen, this is one of our big themes for this year is it's a no-holds-barred year because it's an election year. And pretty much every tool you can think of is being used, whether it's the TGA, whether it's reverse repo, whether it's the Strategic Petroleum Reserve, student loan forgiveness. It's all being used, and it's going to keep the economy, I think, pretty robust. If you look at the Atlanta GDP now forecast for the second quarter, it's at 4%. The only issue, I'd say, is that there is a cost to keeping an economy out of recession at all costs, and that's generally speaking inflation. Or longer-term, higher longer-term interest rates. So, that's what we have to watch out for. Right now, it seems like we found some sort of happy medium with the 10-year Treasury, with some signs perhaps that the labor market is weakening. But the supply alone, in my opinion, could drive long-term interest rates higher in the future.
Yeah, I thought